Hello, welcome back to Tab U. My name's Katrina and I'm joined with Ellie and David. We're back for another episode on venture capital. Would you guys like to introduce yourself, Ellie?
Hi, yes, I've been here before. Eli Korman, Chief Investment Officer and Head of Development Finance at TAB.
Welcome back.
Thank you.
David?
Hi, David Bloom. I am a partner at the Noé Group, founder of Goldacre Ventures and founder of KO Data Centers.
Welcome. We're going to, same format as last time, we're going to be asking the top 5 questions that have been asked on venture capital, and we'll kick things off with question number 1, which is, what is venture capital?
What is venture capital? It's a reasonably good question, actually, in the sense of, if you look at it like this, it's more than just investment in a company, because obviously you can get investment in a variety of different ways. Venture capitalism at its best is meant to also provide mentorship, access to distribution, and generally in a portfolio approach, allow companies to grow on their own terms with money that they otherwise wouldn't have to accelerate, because it's outside the normal growth curve of a business. So it's not organic growth, it's inorganic growth.
So how do venture capital funds actually work?
Venture capital funds raise a bunch of money, and then they go and take that money and they invest it in a number of different companies, usually along a theme. So there are generalist funds, but they'll act at different stages. So most venture capital happens at the early stages of companies, which is defined as seed or late seed or Series A or Series B. I mean, the industry gives itself its own sort of naming conventions, exactly. But the principle is that you're putting in money early on. It's high risk. But the returns are commensurate with the risk. So ultimately, you'll find that these type of check sizes are anywhere between $500,000 and $5 million, dependent on the size of the round and the stage of the company. And the expectation, obviously, it's not true in every case, and we can talk about percentages of success. But that ultimately that money will return sort of 3 to 4 times on average across the portfolio. And obviously you have outliers that we'll all read about in the paper, like a Facebook or a Uber. Now, different companies work in different spaces, but we'll come on to that. But ultimately, within a portfolio, there will always be, if you're successful, a couple of outliers that significantly outperform the sort of 3 to 4 times.
And what's the difference between a venture capitalist and an angel investor? Is it Well, I'll let you explain that one.
What is the difference? Well, firstly, it's just quantum. So an angel investors tend to be, sub £500,000 investments, and they're not fund based. So, with a fund, you are not investing on a direct one-on-one basis. You may have a portfolio. Say you've got a 50, 75 million pound fund, which is currently what we're in the process of closing. You're going to deploy that over 3 to 4 years into 20 to 30 different companies. So it's a much more portfolio approach. Whereas an angel investor, tends to operate at the other slight end of the scale of sort of pre-seed or very early in the company's existence, and tends to do it on a one-to-one basis. Now, there are angel clubs where a bunch of angels will get together, and that brings the mathematics of spreading your risk. I think the other major difference is that venture firms are set up, with larger teams with the objective of helping their companies grow. So a lot of the businesses that we invest in, we don't just write a check and disappear and wait for the quarterly report. We will look to introduce those companies to industry players in the appropriate industries. We will help them, hire. We will broker deals with them. So there's a lot more hands-on input. So we have a team of 7-8 people who do this kind of day in, day out. So I think those would be the major differences between venture capital and angel investing.
You touched on earlier Series A, B, C.
Yes.
How does that work within the stages of an investment within a company or a set of companies? Where do you and where do venture capital sit within Series A, B, and C? At what points do you get in and what points do you get out?
So Goldacre operates in late seed, Series A, and often Series B. Now, the Series B will be a follow-on. So again, a bit of math. I know Ellie likes a bit of maths.
Thank you. And a spreadsheet if you can.
Put it on a spreadsheet. But it would be very rare for us to go in cold to a B round. That's usually a follow-on investment, right? So in each round there will be possibly new investors, but you will have always maintain the rights. So the reason why to come earlier into a business is because you get the rights to the follow-on investment on your pro rata basis. So ultimately is that those B rounds, and when we recently and that company just actually closed a C round, an Israeli company called Breezometer, that's in the hyper-local air quality space, which is difficult to say, but very interesting sector. So we were in their late seed, then we co-led their round A, and then participated in their round B, and then this round we didn't. So now what happens, right? So the exit is either via three routes. One, if the company continues to raise further rounds, quite often earlier investors will take an exit at that point. So it's not uncommon, especially because the larger, when you move into very large VC funds or private equity funds in some cases, they'll want to tidy up the cap table. So take out some of the smaller investors and just tighten up the whole thing. Obviously, a lot of companies at the moment are preferring the public markets route, so they will go for a listing or end up in a SPAC, a SPAC. So it's SPAC season, which is not something I thought I'd ever say. But so a SPAC is a special purpose investment vehicle, otherwise known as a blank check company. So what happens is that people go out and they raise a usually not insignificant amount of money on the basis that they into a public vehicle, on the basis that they will go and use that money to acquire private businesses into the public vehicle. So it's another way. I was going to say something. I was going to say it was a backdoor, but it's not really. But it's another way to list assets, as opposed to doing it on a one-by-one basis. So a SPAC's already listed, but all it is a cash shell. And then what you can go and do. So I mean, probably every day this week, there has been another. I mean, in this case, I primarily follow the Israeli listings, but there's been another company listing on the NASDAQ or listing on the New York Stock Exchange through a SPAC. They become popular, I have to say, when there is a lot of money out there that is waiting to find a home. So it's very true to say at the moment there is a considerable amount of capital out in the market that hasn't been deployed, sitting in funds of funds, private individuals, and because of the uncertainty of certain sectors that would previously be safe havens for capital, they are looking. So what the SPAC offers is it's essentially a guaranteed return in the sense of whilst I'm holding your money, it's accumulating almost like a loan note. So whatever happens, you then theoretically get a return. But obviously, in some cases, it also caps your upside. But that's a SPAC story for another day.
That's the next podcast.
SPACs. What are SPACs? Yeah.
Well, if we go on to question number 2, which is what do venture capitalists invest in? You kind of briefly touched on things that Goldacre did, but can you expand on that?
Yeah, absolutely. I mean, again, these are all general rules. So if you're trying this at home, don't worry if you're not doing all of these things. But I mean, fundamentally, in today's economy, venture capital is primarily directed at technology companies. And the reason being is that if I start a different type of company, venture capital isn't for every business. And what I mean by that is there are plenty of businesses that offer a service, charge a fee, make a profit. It's very, very, very old school, and then kind of move on to the next stage of growth. Whereas technology companies take a pretty decent level of investment to build a platform. I mean, Tab being a good example, you'll have invested in your technology platform, as I know, and that's kind of the upfront investment and the basis of the growth, right? Because what you're able to do then is you're able to scale in a way that you wouldn't be otherwise, right? So venture capitalists invest in if they're good venture capitalists, they invest in scalable things, so things that have either universal or global reach, something that you can really see being a pervasive technology, or something that's really going to be able to geographically transfer or sector by sector as well. They look for experienced teams. They look for often have sector specific investment criteria. So in our case, for example, we are very much focused on what the man on the street, I'm not sure, it depends what street you go to, but would call prop tech or property technology, the smart built environment. So we are very, the Noé Group itself, it has a very long history in real estate. And my job encompasses everything that isn't real estate, and really looking at how that sector is changing and the technologies that are impacting it and the opportunities that offers. So we do look, in our case, at a very specific subset of sectors, and then you are looking for USPs. Sorry, I don't. A terrible use of acronyms. Unique selling points. You're looking for defensible technology. Is what they're deploying patented in any way? What other competitors are out in the market? And so then, lastly, you take all of those factors. And then there is just a value judgment of where you think the sector is going. Because often as well, and we can talk about this later, but you can end up in a situation where it can be a theoretically fantastic company or idea, but there's just no demand for it from the end consumer. And one of my big bugbears is, from my background, which is, though I have always been involved in technology and technology investing, I'm not a technologist, and so it's always that disconnect between what's possible and what the end customer or market actually wants, and I think that's an important element.
You touched on PropTech, and
Yes.
You mentioned the family office's experience in real estate and your experience within the technology field.
Yes.
How do you find that? I mean, PropTech is obviously a big buzzword on the street at the moment. How do you find that is? Do you feel it's an industry that is overquoted and over-discussed? Do people really understand what PropTech refers to? And obviously, PropTech can refer to a very wide range of set of companies and what people do. Even part of what we do at TAB, we view as a bit of PropTech to an extent,
Yep.
And a bit of fintech to an extent as well. So how do you work on that within what you see through Goldacre?
I mean, you're absolutely right. PropTech can often be used as a catch-all for a bunch of stuff that vaguely fits into the category. We are a bit more ruthless in the focus. We primarily look at three areas: smart buildings, smart cities, and construction technology. Now, and as a wrapper around that, it is often running through as a theme is sustainability, because those are, in our mind, the real challenges of the sector. How do we run our buildings more efficiently? How do we make them more flexible? How do we allow the interaction with those spaces to be more meaningful? Similarly, on the city level, everything from last mile logistics to dark kitchens to my fundamental belief, and it is a belief, it sounds a bit evangelical, but is that at the end of the day, land always has a value, and it's really a question of its usage. And usages change over time. So this idea that we've invented a new category called PropTech and it's something that's not been around before, I don't think is true. I mean, I think innovation in every space has always been there, and sometimes it's been faster and sometimes it's been slower. I mean, my favorite property example is that you can tell a story that isn't actually that up to date, but sounds quite recent in the sense of, the guy who shows up and he's come up with this metal box that takes people up and down the stairs, so they don't have to walk up and down the stairs. Yeah, and he'll try and sell that into building owners, and someone will go, "Oh, I'm not sure about that. It doesn't, obsolescence, and what if they come up with a new lift? Yeah, and what, oh, I'm not sure." So all the same questions, and then there'll be the guy next door who say, "Well, actually, I quite like the look of this." Now that dynamic changed real estate, because up until before we were all born, I hope, is that the top floor of real estate was actually the cheapest. So this whole idea of a penthouse or whatever it was didn't exist, because actually you didn't want to walk all the way up the stairs, and there was also a limit to how many floors you could actually have, because frankly, after a certain point, outside of the sort of fit guys like Ellie who enjoy these
running up and
running
down
up and down the stairs, yeah, people didn't want the 8th floor or the 10th floor. So there you go. I mean, I'd love to put a date on it, but when that occurred, it changed real estate, because you could then suddenly, in the same location, building next to another building, you can build another 8 floors. Yeah, your top floor became more valuable than your ground floor, and the whole thing changed. So it's untrue to say that people like to accuse real estate of being an uninnovative space. I think that's very untrue. Having said that, the structural changes that we're seeing now are quite fundamental, and so we're very much focused on areas where we can see really long term. As having a mindset of family office capital means you're not looking at, I've got to turn something in 3 to 5 years. Yeah. Now you may very well do that, but you're not obligated to. And so therefore you're looking at the long term and saying, well, hang on a minute, what is really going to change here? Some of my obsessions, and they are obsessions, focus in on areas such as how we're going to fulfill stuff, fulfillment, logistics. It's still a long way to go. I mean, we think we're doing a really good job, because humanity tends to think that. But the reality is there's so much more to go, and there's actually quite a large amount of inefficiency. I mean, you probably know yourselves from being online customers. Everybody's an online customer of something. And in my household, between my children and my wife, I mean, I feel like the Hermes and DPD guy just drive around coming to our house, right? Now, if you sit there for a day and think about it, the rank inefficiency is huge. Yeah, you can have 4 or 5 of these deliveries, all from different people, all from different places, all coming from distribution hubs that sit outside the cities. Yeah, and they're coming in, congesting the roads, right? So we've got a last mile issue, we've got a delivery issue, we've got returns issue. What online retail wakes up in the morning and thinks about is a returns problem. I mean, I don't know if any of you have been following this, and I'm really hogging the conversation. So please do stop me after a while. But so in the US, in certain parts of the US, Amazon are actually trialing, would you believe, that under a certain price point, if you want to return the item, they just say, keep it, give it to charity, do what you want with it. Yeah, because actually,
and then just refund you.
Yeah, because the cost of getting it back, putting it back into the system, repackaging it, in a lot of cases it's grey goods, it's just not worth it, right? So it's amazing to think that it's actually more cost effective to just say, under a certain price point, you know what, have it. Yeah. So of course, I've got loads of friends who are trying out to see where the price point stops, right? I've bought this brand new television. I don't really want it, but I'm sure that for larger items it's not the case. But it's just very interesting. So we're there as a venture firm, and we can talk about. We launched an accelerator. We're going to talk about later, but to really look at those real problems, the things that we really see opportunity in, and by creating more efficiency, you'll improve customer experience, you'll improve bottom line, and you will bring a different dynamic to the value of those assets.
That's really interesting, and I think just tallying with that, bring us on to the next point of data centers. Again, you touched on a little bit earlier with KAO, which I know is a huge data center.
KAO?
KAO. I'll leave David to go into a little bit of details about what KAO is. But data centers, again, it's a touch on a bit of property with a land value, but then it's technology, because as we all take everything online and all our filing systems become all automated and sit on your computer and in the cloud, that has to sit somewhere, and that's where data centers fit in. And again, David, I mean, if you tell us a little bit about data centers. So
let's start vaguely at the beginning, bearing in mind that people have weekend plans, but so KO, which is named after Sir Charles KO. So Charles KO and his research partner George Hockham. Bit of history here, bit of history lesson. So they actually were the first research party to invent what we now call optical fibre. So optical fibre, you know how BT try and sell you fibre broadband, or fibre broadband that is only 100 meg at like 2 minutes past 12 on Christmas Eve. Yeah. But the whole point. So that was, they invented that. Would you believe, in Harlow in Essex? Very fancy. The other thing to come out of Harlow actually was the recipe for Irish cream.
Shout out to Harlow.
Absolutely, big Harlow fan. So our first major data center campus is in Harlow, and on the site that this invention took place. But Ellie's absolutely right in the sense of, again, the sort of digital backbone of the economy. It's coming to the forefront now in terms of you can open the paper now and read about supercomputers and data deployments and 5G and what that means. But it's been there for close to this scale for close to a decade, but it's just kind of been in the background. So we build and develop these centers. We have a joint venture with Legal in General, and it's a fascinating area because ultimately these are very technical buildings, as Ellie says. So yes, the land element is a really good classic and good example, because it used to be, when I started it 10 years ago, what they would call an alternative asset class. So you had all your mainstream offices, retail, and this was an alternative. Nowadays, I mean, it's practically mainstream. I would class it as mainstream, and it absolutely has changed the dynamic of those land values. So if you look at the valuable clusters of data centers, say in the London market, so Europe. The major markets are London, Stansted, London, Frankfurt, Amsterdam, Paris, Dublin. But London by far is the largest market. And you look at areas that you would have not considered to be valuable real estate. So one of the big clusters in the UK is in Slough. So the Segro estate in Slough, lots of data centres, very valuable. But so again, it's changed the dynamic of the underlying asset value there. But the difference is that they're very technical buildings. Mm-hmm. So the vast majority, you're spending large capex on M&E. Mechanical and and electrical. And these buildings are built to be super resilient, right? So, I mean, I was just there yesterday because we are putting live the UK's largest supercomputer. The
one we saw in the papers recently.
That's the one we saw in the papers recently. Yeah.
Shout out to Harlow again.
Big shout out to Harlow. And the head of the council asked me yesterday, what makes a computer super? So I told him is that unlike all the other computers, it wears its pants over its trousers. But that's not actually the answer, by the way. Sorry. The answer is much more to do with the level of compute it can. So if you think about your Ellie's Excel spreadsheet, right? Yeah. So if he, back in his trading days, if he would do a really complex spreadsheet, it would actually slow down his computer. Yeah, because there's all these macros and all the things that he's built into it. Now, when it comes to, say, medical research, you've got to times that by 500, right? So the number of streams that they're running, which is why let's bring it relevant to vaccines, right? So one of the reasons we've managed to develop these vaccines so quickly has actually been down to the digital life sciences, because we're able to run scenarios on supercomputers so much quicker than we could have done, that we can basically cut the time down of the research to understand what the outcome is going to be in the modeling, to be able to move on to the next stage. So these things are impacting every element of our lives, and I'm still, even sort of 10-15 years later, generally excited to go to work, because there's always somebody comes in with something new and exciting.
That's fascinating. And where? Supercomputers in Harlow. Does it have a name?
It's the Cambridge one.
Cambridge one.
Yeah.
In Harlow. That's
in
not
Harlow,
necessarily near Cambridge, is it?
Well, I mean, it depends on which estate agent you ask, really. It's Cambridge borders. So actually, another fun fact. It's fun facts from David. So the London Stansted Cambridge corridor is the largest has the largest concentration of life sciences companies. It is the life sciences corridor of the UK. So company all the way from sort of the Wellcome Trust to Sanger, who actually They were the ones that you may remember mapped the human genome for the first time. So DNA, GSK, all of these companies are up and down the Cambridge corridor. There's a huge, all of these things are connected because, of course, what that does is a cluster. And then we can touch back on venture capital. Venture capital also clusters. You'll have all heard about the valley, Silicon Valley. So, and everyone around the world uses the word silicon. So in the UK we have Silicon Roundabout in Old Street, which is just like San Fran. Yeah,
absolutely. Old Street in San Fran, same place.
Same place. It's like you could close your eyes and it's like being there. But so the same as well for a lot of sectors. They cluster together because it's better for infrastructure. It's better for innovation. I mean, if you follow that spine up, you could basically go London, Stansted, Harlow, Cambridge. So it's about from Harlow. It's about 25 minutes into Cambridge.
Oh, wow, that's way quicker than I thought. Maybe I'd go back to geography lessons.
Next episode.
Yeah.
I mean, to the outskirts of Cambridge. Let's say that.
Well, that kind of brings us on to question number 3, which is what do venture capitalists want in return? You kind of touched on before how much you might put in, but is it, I guess, let's go, it's obviously financially, I guess you kind of want that return as well, but do you go in, you help, you give advice, you mentor? I guess, what else do you do? Or is that all of it?
What else do we do? I mean, yes, of course. I mean, the aim of the game is to make economic return. But I mean, again, I don't want to make this sound like like we're saving the world here, because we're really not. But occasionally you do, but it's usually by accident. In that, it's also, you want to do this job because you like to see companies grow. Yeah, and sometimes, and it's not every time, because by the sheer mathematics of the whole thing, there is the science and there is the art. And the science says that you're not going to, by definition, in terms of the percentage chances of new companies succeeding, you're going to have losses, people that just don't make it. But on the flip side is you just get these companies sometimes that really do just make it, and that's great to see. I mean, it's really satisfying, especially when you've got founders who really have put their heart and soul into it, really believe in the mission. And a lot of these companies do have, I mean, I mentioned it before, but and I can explain what it is slightly better this time, in terms of, Breezometer genuinely help people understand air quality. And air quality is pretty important because we all breathe the air, and that's pretty critical. You have to keep on being able to do that. And we all know from the Paris Accords and a variety of other things that it's something we need to address as a society. What are we putting into the air? How are we affecting our kids in terms of what they're breathing in from fumes in the street and all this type of stuff? So when I see those guys grow, I mean, they've just done a global deal with Apple. So if you have an Apple iPhone, you can get it out now. And in the weather app, you'll see that there's now new pollution data, and that's driven by Breezometer. So that's exactly. So you get moments where you think, actually, that's quite a good
they're
thing.
onto something, and they're providing value back to everybody. So.
Yeah, and it's a bit like having kids with slightly less capital cost, in the sense of. You just see a company grow and accomplish and achieve, and that's really quite satisfying.
That's really cool. It sounds quite. I'll be going checking the weather quality, air quality.
Absolutely, you've got to check it out.
I checked the UV rays, which I guess must be kind of linked to another company that's doing that. I just thought Apple sort of made that and did it itself. So quite cool. There's something else behind it, and now one of them's Breezometer for the air quality.
Yeah, absolutely. And look, and these things, sustainability we touched on before as well. Yeah. It's super important. I mean, we have a responsibility for the planet we live on. And again, some of these companies, it may fit. We had a cohort company in the last Relab program called QFlow, which and again, what they do can often sound quite boring, but it's not. In that. So little do most people know, but the sustainability of materials on building sites are actually quite important. So on a very large building site, and again, this is sort of showing Ellie's vast career, but he's also done that as well.
Thank you very much.
Yeah,
a
bit another plug for Ellie. But you can have 5, 6, 10, even just timber suppliers, right? And you now, as a company, have much more responsibility to understand: is that timber sustainable? Where has it been grown sustainably? Where has it been sourced? Yeah, what are the labour conditions? And so QFO, has built end-to-end technology that allows people on building sites to basically record that really simply, and understand. So and track their materials in a really meaningful way. So again, smart company addressing a problem. But also, doing a little bit of good, I suppose, in terms of, and that's not every venture capital investment, but more and more, I think the businesses that will be successful are those that, can demonstrate what their social purpose is as well. I think that's a growing trend.
When you have those types of businesses like Breezometer, which are exciting, you see the value they're adding to the local communities, the wider communities, and the world at large. How do you decide at what point you're looking to come out of an investment with them? Because there's an emotional investment there as well, where you want to see that through to the end, whatever the end is. And from a financial perspective, it's nice to see a return on your capital. There's an emotional part of that where you want to stay in for longer. So how do you weigh that up?
Yeah, I mean, that's absolutely right, and I that's why you have teams and other people. I do get sometimes a bit emotionally attached to, as you can tell. I'll try and hold it together. But ultimately you have targets. You have target return, and when you see an opportunity to meet that target, across a portfolio or across a fund, it's your obligation really to take that, because you've taken the money from investors and said that you'll get them a return, and that's your primary objective. So yes, so you can't treat it like your own money, in the sense of you have to feel responsible for it to the extent that it's your own. But on the other hand, you don't have that luxury of saying, well, actually, I really love being involved in this company, so I'm going to stay. So that really, the maths answers that question. When you've crossed a certain threshold. Now, if you believe that there's so much more to come, that this could potentially give you outsized returns, and that's a good reason to justify remaining. But yeah, I mean, you have to be in the end driven by the purpose of why this money's been entrusted and you've invested it, is because you want to give people a return. So, and
I suppose at each stage you can come out when you want. If you came in at pre-seed Series A, let's say, you could take a bit of money off the table at Series A. You could stay on a bit further and take a bit of money off at a later date. So you're providing returns, and then if you see
I mean, if that's available, again, the other thing to really point out is I don't know what your what the regulations here are at the podcast in terms of it's not for listeners at home. It's not a liquid product, right? So. You don't. It's not like a publicly traded share where you just go back to the market and say, "Okay, I'd like my money now." So yes, usually at investment rounds, there can be an appetite from incoming shareholders to get a bit more stock and take some, and allow some people to cash in those shares, but not always. So you have to, and that's again about weighing up. So if that comes up, it's not necessarily true it's going to come up the next time, and you might be in for longer. And time is a factor. I mean, when we all calculate returns, and even when you're proposing a bridge finance, you're looking at it over a certain time period, and so that's what helps dictate what the actual return is. If that time period were to double, the reality is your return has in IRR terms anyway, has diminished.
Yeah, that's agreed.
Yeah.
Cool. Well, moving on to question number 4, which are what are the pros and cons to venture funding?
So, I mean, look, I think let's start with the pros. It's a Friday, let's be positive. I think the pros are it can allow a business to accelerate non-organically. So it stops a business being reliant on just reinvesting money that it makes in profit. So it can, and it allows it to invest in infrastructure and development and the things that it kind of needs to set a path to success. Now, so there can be downsides in the sense of, especially in a hot sector, in a hot market, sounds crazy, but you can take too much investment capital. The other thing is that you give away too much equity, you take in too much money, and then you're not ready, you're not geared up for the growth. But the expectation of the investors is that you're gonna go and spend that money and do that, and that can often unravel the whole thing, because there's a fine line between not progressing and being too pedestrian, and then over expanding, overreaching, and that can be a challenge. And I think that you've got to find the right investors for your business. And what I mean by that is, so again, are we the right investors for a business to consumer social media product? No. And if you took our money to do that, it would be a mismatch, and we would probably not have a great ride together, because we can't add any value. We're not really, it's not a market that we are familiar with. And so, we just won't be at the best productive investors, but at worst, we will err on the side of caution when we shouldn't, because we don't really understand the market. So I think it's important for companies to not just jump at the first check or the first person prepared to. I always recommend, run a process, meet more than one party, really sort of think about what it is you want from an investor, and also look at the balance in terms of, where are decisions made, how are they made, governance. So there are lots of ways you can get it wrong, and I think it does take experience on both sides to make sure it's structured correctly. But in the main, I think it's a good source of capital to accelerate businesses. It can also be expensive, by the way. So you're giving away equity, and I always worry when companies sort of say, "Well, I can't pay you, but I'll just give you some equity." It should be the most valuable thing you have, is the equity in your business. Otherwise, you don't really believe in the business, I suppose. But so you're giving away something precious. Make sure you're giving it to the right person. This turns into more of a dating podcast. But make sure you give it to the right person, and that otherwise you won't respect yourself afterwards.
Just something that's going through my mind at the moment is, if one was to buy shares in a company, they have no say in the way that company runs. When you invest in a company, you obviously want to have a bit more of an input and a say into how it runs. So what do founders of these types of companies that are coming to venture capital and getting investment from them, what do they need to realize and think about in terms of the involvement those investors will have within the direction and growth of that business?
So again, it's true to say that if you just buy some publicly listed stock, you own shares, but you don't really have much say. Having said that, in an extreme, if you're a large pension fund and you buy 10% of the business, you do really, as a major shareholder, have a say in when votes come up. And we've seen this. Obviously, one of the big topics recently in public companies has been executive pay, and you've seen kind of lots of people talking about that who are investors in those companies. Now, I think that we always on our sort of larger investments will take a board seat. So it's governance. So there's a difference between economic return and how decisions are made. So yes, you need to think about, are you prepared to take input on your decisions? And if you're not, then that's probably not for you. In most cases, we don't solely. There's not one party around the board table that solely can make the decision in terms of a percentage breakdown, and we very rarely, we commonly co-invest, and we very rarely solely invest, because again, you want to see a spread of capital, a spread of skill set, a spread of geographic reach. So that's what it's going to benefit the company. So in the main, there will be within every shareholder agreement thresholds of decisions where you can say, well, for only a certain percentage to make this type of decision, or this isn't a board matter. So without going into the boring legal detail, it's definitely worth working that through in advance with any venture firm that you are taking investment from. And we would want to do the same, because you want to make sure you're aligned in how those decisions are made.
Well, brings us nicely on to question number 5. I've heard all you've had to say, and I'm keen. Where can I find a venture capitalist?
Where can you find a venture capitalist? So, I mean, there are a variety of different routes in terms of you can hire a corporate finance house. So you can say, right, I want to go out and do a fundraise. You take on a corporate finance house, and they have a network into this space. You can network yourself. I mean, self networking is usually quite good, and there'll be again, they cluster together around usually the tech hubs. Speaking to other entrepreneurs, other business owners of who they've dealt with in the past, and it's a lot of
get a train to Harley.
yeah. I mean, the only person you'll find there is me. And you need to take a cab from the station because there's no direct bus route. But I would say that the last approach to it, and you've seen this in different ways. I mean, it's interesting just to touch on it. Crowdfunding has changed a little bit of that dynamic. Of this idea of that I kind of go out to just a sort of more of a retail product,
and anyone can just invest.
But that's again a whole different podcast. But I have some concerns about that in terms of the long-term reality for those businesses. But in the main, I think that if your business, always try and seek out the parties in your space. There will be venture firms who have a reputation in certain spaces, and that's really your ideal candidate. And the last way really to achieve it is to go and apply for whether you call it an accelerator or a program. We run something called Relab. So that's an accelerator which looks at the space that we invest in. And so we run an application process. So every cohort will receive 150, 200 applications from businesses. If you get on the program, you initially get an amount of investment from us, and then subsequent to the program, we choose to follow or not follow that investment. And it's an exciting journey for us. It's a really interesting way of learning about each other as well. So by the end, you've built a relationship before you've taken a major check, which I think is also quite valuable. So there are numerous routes. I would say that for good businesses and for good founders, there is money out there. So just make sure you tick those first two boxes, and you'll be okay.
So tell us a little bit more about Relab. Is it an innovation fund? Is it an incubator? And what are the difference between those terminologies?
So the co-founder on Relab, Fanula, likes to describe it as a ecosystem. So we bring together the industry. So we work with partners from sort of what I would call, in the widest definition, sort of real estate in the smart built environment. You can check them out at relab.tech. But they're companies like DPD, Landsec, even White and Case, right? Because what we're trying to provide is a really solid sort of insight into what those companies have to do to grow. So every company on the program gets a mentor from the space, and then a pilot advocate, and we look to help them to deploy into a new geography or to deploy into a new customer. And so the purpose of the program is for that business to understand what the sector is looking for us to understand what the business does, for there to be. So yes, it is about investment at the end of the day, but it's also about understanding the needs of the sector. I mean, back to almost the beginning of the conversation, one of the things I think it can be a disconnect is that technology in some ways is capable of anything. The question is what does the end user want? Mm-hmm. What does the chief executive of a large real estate company wake up in the morning? What's his number one concern? What's his number two concern? And often you might think you know what it is, but you don't. And so it's those problems that companies are going to engage to solve first, rather than, in inverted commas, nice to haves that seem really good, but they're not really addressing where the pinch points are for these businesses.
Cool, brilliant. Well, that kind of wraps things up for us today. Thank you both so much for joining me, and thank you, David.
pleasure.
It's been really interesting.
Yeah,
I'm
indeed.
sure our
Thank you,
listeners.
David, for much appreciated your time.
No, 100%. Can't wait for the second episode.
Oh, well, yeah, we'll have to get you back. I
The
feel like we
sequel,
barely
is it called a
touched on some
sequel
things.
nowadays. Yeah.
Season 2.
Season 2.
Season 2.
That's been Venture Capitalist Taboo. Thank you very much for watching. Make sure you like, subscribe, and share, and leave a comment below. See you next time. Bye.